Crux, one of the drivers for this webinar is for Crux to download some information on a recent report that they've compiled. It's their 2024 mid-year market update on transferable tax credits. That report in full is available for download, and you can go within this platform. There's a little red button over handouts, and you can download that report. It's full of great information, and so do that. I'm Eric Wesoff, the executive director of Canary Media. Canary is a nonprofit multimedia platform that covers the energy transition and solutions to the climate crisis. And we're going to be discussing tax credits today. Now, if you signed up for this webinar, the webinar named Dynamic Tax Credit Transfer, if you signed up for this market, you're most likely in this field. You're a developer or a banker or a financier or someone who's interested in this, in project development. But we do see some names on the attendee list who are people who are energy curious and generalists, and we want to make the webinar understandable to them. There may be some people who got here by accident who are looking for Olympics or election coverage, but please stay. We'll make this worth your while. You'll learn about tax credits. When an engineer walks by a solar farm or a wind farm, they see hardware, they see physics, they see chemistry, they see mechanicals, and it looks to them just like a physical construct. But when a financier or a banker or a developer walks by a solar farm or an advanced manufacturing plant, they see it in financial terms. And one thing that's unique about the United States and Canada is that our infrastructure in climate and other infrastructure is generated through the tax code. And the IRA, the Biden administration's epical policy, which I think celebrates its second year anniversary this month, established a new type of tax credit, a new type of financial tool that will make building infrastructure more efficient and more transparent to the parties. Not every country uses the tax code as its enabler for infrastructure, but we do. And by making something called a transferable tax credit, which monetizes that tax credit immediately and creates a cash market for it, it speeds up this market. It acts as a supercharger for building infrastructure. So I hope that that's a fitting introduction to what we're talking about here. Despite its somewhat wonky tendencies, it is an essential change-making tool that is available now to bankers and developers to supercharge the IRA catalyzed infrastructure build of confronting the renewable energy transition and onshoring American manufacturing. Okay, I'm sorry for that. I hope there was some content in that introduction. I'd like to introduce you to Alfred Johnson. Alfred Johnson. He's the CEO and co-founder of Crux. They are a startup that has received some venture capital funding recently. But what they are really trying to do, they are not only a startup, but they are at the forefront of a new market, of a new asset class. And it requires them to be both a financial startup, a sustainable financing startup, as well as a market enabler. And that's something that this report we're going to be talking about today is one of the purposes that it's doing. So, Alfred, could you tell us a little bit about yourself, about your background, and about the formation of Crux and why it's so absolutely necessary to have, and why it's catalyzed by the IRA?
Yeah, Eric, I will do that. But first, I want to observe a couple things. You are correct. Today is actually an auspicious day in the history of the Inflation Reduction Act. It is the day that it was passed out of the Senate 2 years ago and signed the following week. So it is fitting that we are getting together on the 2 year anniversary of that. And Eric, I have been a longtime reader and consumer of Canary media information. So it is fun to be here on an event hosted by you. I'm Alfred. I'm the CEO of Crux. I've spent my career between software, financial markets, and the government, which actually are the constellation of those things is where we are building with Crux. I began at the U.S. Treasury Department on the same day that the market bottomed in March of 2009. It was particularly dark days in financial markets, and got to understand how the system fits together from the perspective of the team that was working to try to support the banks and other financial markets to get back to health. I then started working on the Recovery Act, which was at the time one of the largest pieces of energy policy and climate legislation that had ever been passed, including some tax credit components to it. Was working on the 1603 grants program and other pieces of energy policy of the time. Went into the White House, where I worked for Bill Daley when he was President Obama's chief of staff. The fun thing about that, Eric, is he is now back as a senior advisor to the company. So getting to work with him again. And then went to BlackRock, was working on structured finance advisory in the context of complex securitizations and the ways that banks were interacting with those novel markets. So really got to see that market evolve as well. Got into tech after that, built and sold a marketplace software company, and went back to Treasury. Was working on the COVID response. They were trying to get $1 trillion out the door as quickly as possible in the context of the American Rescue Plan. Was working on the operational execution of that, as well as technical and financial markets issues for the time before I left. Left in the summer of 22, really wanted to start something in the climate space. And in that time, the IRA passed, and for whatever weird reason, was on a plane with my wife and 2 kids, and ended up pulling up the statute on my phone and reading it, which, as you can imagine, was a thing that my wife was very appreciative that I was spending my time doing. And as I did that, came to the conclusion that the law is overwhelmingly tax credits, and the fact that they are made transferable for the first time is a huge unlock. But this market that we are working on trying to bring together, needed to form in order for that policy to be as effective as it could be. So in a moment, we'll go into the history of the company, the history of how the market has come together. But the short story on that, Eric, is that this market has formed much more rapidly than anybody thought that it would. And we'll show some data on just exactly what that looks like in the context of pricing, deal dynamics, and the way that people are interacting with each other.
Okay. By the way, for all of you whose spouses are just give you a blank stare when you talk about transferable tax credits, this is a safe space for you, and you can talk about it as to your heart's content. Forgive the levity, but I think it makes sense. This is not exactly cocktail party that instilling conversation, unless you're with a bunch of developers.
I maintain that it is actually more interesting than it sounds.
I agree, and we're gonna make it that.
We'll see how many people stay on by the end of the call.
For sure. All right, that's the test. So, tell us a little bit about. You are a startup, and Alfred, tell us a tiny bit about the funding event that you had recently.
Yeah, so we started the company in early 23, around the same time that it became legal to transact the credits. Raised about $9 million in our first set of venture and strategic capital raising. That came from Lower Carbon Capital, Overture, New System Ventures, and then a handful of strategics. So Ørsted participated there, LS Power, Canopy Ventures. That then allowed us to form the company, hire the initial people, really start to move in the market as it was accelerating at the back half of 23. And then most recently, Eric raised a Series A led by Andreessen Horowitz. It's a $18.2 million round, and exciting development as part of that. We brought in Clearway, EDFR, Pattern, and Intersect into that round. So collectively, investors in the company now have more than 100 gigawatts of pipeline. And that's particularly exciting because we get to work with just the best people at those companies to define what they need in a market that is growing as quickly as it is. And because of that, are able to move even more quickly to make the market on these credits.
Okay. We discussed earlier that as a pioneer and a pathfinder in this market, you have to do a number of things other than just financial engineering. You have to act as a PR agency for this newly established market. You have to act as a market analyst. If a venture capitalist asked you, what do you think the total deal size will be in 2 years? There aren't that many marketing houses to do that, which brings us, it's a good introduction to Katie Bays and the report that she helped compile. She's the research strategist, the policy and research strategist at Flux. So in your capacity as new market analyst for this newly formed market, Katie, tell us a little bit about the why you put the effort in to do this very detailed report, the stakes of the report, and some of the stakeholders that you reached out to.
Yeah, absolutely. Thank you, Eric. And I would say, my background before joining Crux is really focused on energy, economic, and financial markets analysis within the energy complex. And because of that experience, I have a lot of experience working in commodities and know how profoundly the capital markets rely upon the commodity markets to be able to build trust and invest around the energy complex for all of our different energy products that we produce and consume every day. And so if there were anything that we could bring to the table from a research perspective at Crux, it would be the ability to build that transparency and visibility and ultimately liquidity into the market for this brand new asset class, and to try to make this, obscure, maybe a little opaque market feel, if not fun, at least engaging and accessible, clear, predictable, and investable for capital markets. So that was a huge part of the initiative that we were undertaking when we reached out to about ultimately several thousand market participants to try to gauge their level of market activity in the first half of 2024. And this is building upon a similar report and process that we did at the end of 2023 to characterize the first year of transferability and what was going on in the market when it was just barely 6 months old. And what we found was, that there were hundreds of different market participants, advisors, buyers, and sellers of tax credits who were active in this space, who were doing deals of all sizes, ranging from just a few $100,000 up to hundreds of millions of dollars. And that when you put and package all of those deals together, you analyze what was ultimately just about $7 billion worth of transactions, what we found is that you can draw certain conclusions from that information about how credits might price, what sorts of deals are transactable, what buyers are looking for. And the reality is that the market really needs this information. So that's why we published it into a big, long report and want to talk about it with you all today. Oh, Eric, you're on mute.
Yep, I am out. Rookie mistake. We are going to go deep into this report, and Alfred's going to narrate a number of slides from it. But stepping back, Katie and Alfred, what you want in establishing a new market, a new platform, a supermarket for these tax credits, essentially. You're the supermarket operator, but you're not the customer and you're not the supplier. Your currency, other than a competent platform, is the trust that you have from both sides of the transaction. And I know that's a little softer of a topic than you might discuss in a financial engineering discussion. But Alfred or Katie, tell us, I know that it's a fuzzy item, but that lurks at the center of a lot of what you do. And so could you, before we get into deal size and 45X tax credits, talk a little bit more about forming a market and developing trust?
Eric, I love the question. And first of all, I love the supermarket analogy. The other week we were called Tinder for tax credits. So I think yours is a little better. So on trust, these deals are really important to all sides of the transaction, right? If you're a developer and you are building any sort of renewable infrastructure here in the United States, the tax credit may make up 30% or more of the capital stack, and getting really efficient execution on that with quality partners is something that is existentially important to you as a developer. And comparably, if you're the tax director of a company who is charged with making sure that the company meets its obligations to the government and doesn't take undue risk and is able to use their tax capacity to advance the objectives of the company, you similarly take a transaction like this extremely seriously. And so to Katie's point on the value of transparency, one of the things that we found in the early market is that neither side really knew how to navigate the transactions and what was a good deal. So we spent a lot of time in trying to inform the market of that. It was the genesis of the early report that we put out to try to give the market some visibility into pricing and deal dynamics. We recently put out a document, a long white paper on risk and diligence standards in the market. We're investing in things like standard documentation and other insights to help the parties feel confident in transacting. And so everybody that is coming to the table knows what to expect, knows what they're going to get, and can navigate the risks that may be inherent to any kind of financial transaction appropriately. And I think that approach has been successful because people are increasingly feeling confident to participate in the market. And we do see the impact of that in the pricing and the volumes that are beginning to transact. Eric, you muted again.
Yes, I hope that digression into the trust topic was, I think it's applicable and important. And
I totally agree.
Great. So, Alfred, why don't you take us into some of the slides and some of the findings of the report?
Great. So I will present 6 findings of the report. Katie talked about the substance of it, how we came to these numbers. We talked about the survey of more than 100 participants in the market. We also supplement that survey data with publicly announced deals and Crux transaction and bidding data. We are increasingly seeing high volumes of bidding on the platform. We've seen more than $8 billion of bids so far this year and saw $1.3 billion of bids just yesterday. So we increasingly are seeing a lot of visibility into transactions.
Say that again. Say that again about yesterday.
$1.3 billion worth of bids yesterday. So the market is really accelerating. We're seeing higher volumes of bidding on the platform. People who list credits are quickly seeing bids, and I'll show you some data on what that looks like. But those are the inputs to the survey. For the 6 takeaways, 2024 is off to a really good start, and we expect a stronger finish. Deals are skewed towards established technologies in the first half of the year. That's a really interesting finding. The market in 2023 had more distribution. The early first half of this year market is more wind, solar storage. I'll show you what that looks like in charts. Average pricing in 23 in 24 exceeds what we saw in 23, in part because the deals that have transacted in the first half of this year are larger, and size tends to be correlated with price, which is the next finding. The pricing and insurance tend to be dominant in terms of the price that the credit ultimately trades for. The market is increasingly competitive and transactable, which is accruing to the benefit of sellers, but also buyers who are able to see the widest segment of the market, find pricing more easily and transparently. And then last, buyers are increasingly looking to 2025 and 2026. Some of that 1.3 billion that we saw yesterday were bids on 25 and 26 credits. And that would be a very constructive dynamic. The market has been liquid for 23 and 24 credits, has not yet been liquid for 2025 and 26 credits. But liquidity there has other benefits to developers. For example, if you're able to secure a commitment on future credits, it leads to the financing of the project being more efficient and less costly. So into the takeaways, 2024 is off to a strong start with a stronger finish. When we're thinking about aggregates here in the market, the tax equity market, which substantially everybody on this phone call will be familiar with, was the precedent market by which credits were monetized. In 2022, that was an $18 billion market. In 2023, it was about a $23 billion market. We expect the total credits that have the potential to be monetized in 2024 to reach 45 billion. And so a big increase off of the base of the tax equity market, and then it increases from there. And that will be served through a mix of tax equity and transferable credits. Increasingly, we're seeing the tools used in concert. The data that I show on the right-hand side of this screen is the projections by Evercore ISI of just how much credits we'll need to trade in the market on an annual basis. And you see it reaches above 100 billion in credits to potentially be monetized by the late 2020s and 2030. So the market gets pretty big. In terms of this year, we are forecasting, we were able to identify $6.8 billion of specific transactions. That allowed us to estimate that the market in the first half of the year was 9 to 11 billion, and further estimate that the market for this year in just transfers will be 20 to 25 billion. So a pretty nice acceleration in the transfer market off of the baseline of 7 to 9 billion that we estimated for 2023. Supply is skewed towards established technology types. I mentioned that the 2023 market had a lot of diversity of technology types in it. You can see that about half of that market was wind, storage, and solar, with a large portion, the remaining half, coming from advanced manufacturing, biofuels and RNG, EV charging infrastructure, things like that. This is a little bit harder to read, but this is the supply in the first half of 2024. The purple is solar, the dark blue is wind, the light blue is solar and storage, the teal is storage. That adds to over 75% in those categories, with another 16% coming in advanced manufacturing and bioenergy. And the demonstrable fact there is that the credits that have transacted in the first half of the year are utility scale, wind, storage, solar, sold by established developers in the field. I think as the market goes on, we will see more new credit types trade in the market. We are currently working on more than $1 billion of 45X transactions. We have an exclusive listing of $100 million of 45U nuclear credits. So as the year goes on, we're going to see more different types of credits make up more of the composition. Right. Just in terms of forecasting, this is that same Evercore ISI data, but breaking out by credit categories. These are estimates of what the uptake will be of the various categories. And you can see the dark blue is clean electricity, but the light blue is advanced manufacturing. That gets quite large, with the balance coming from hydrogen, carbon capture, and other things like that. Takeaway 3, average pricing exceeds what we saw in 2023. So in this chart, we have ITCs and spot year, current year PTCs. On the left-hand side is ITCs. It's a little bit hard to see the numbers, but the market average in 23 was 92 cents on ITCs. The market average in 24 is 92.5 cents on ITCs. So a little bit of an appreciation there. And on production tax credits, we saw even more of an appreciation from 94 to 95 cents. And what's reflected there is that investment tax credits are perceived to carry a bit more risk to the buyer. It's manageable and mitigatable, but is still there, versus production tax credits, where the tax credit amount is correlated with the production of the energy, the component, the material. And those tend to trade at a premium because of simplicity and the perception of risk. Here's another look at pricing. One thing that's interesting here is you can see that once you start to get into the larger deal sizes, pricing starts to stabilize in the mid to high 90s. When you're below 50 or 25 million in size, pricing is lower. But the interesting thing there, Eric, from an impact perspective, is tax equity was not historically available to smaller credits and projects. And so even if a $25 million credit is trading at 90 cents versus the larger credit that would trade at 94 cents, they're still getting access to the tax finance in a way that they would not have had direct access before. So we see healthy pricing across the board. In terms of composition here on the market, the 2023 market is shown in blue by size. The 2024 market in this slide is shown in red, also by size. You can see, again, the point that the market has skewed towards the larger deal sizes. As the year goes on, we expect the red to look more like the blue. So more small deals will trade in the market now that some of the large ones have already transacted. Number 4, deal size and insurance continue to play a dominant role in pricing. Again, you can see that ITCs in blue and PTCs have somewhat different pricing dynamics, with ITCs having a bit more of a reduction in price in the sub $5 million category. Part of that is because insurance is not particularly accessible on sub $5 million credits. And so those credits are sometimes trading in the absence of insurance. One interesting finding that we found from the report is that in larger sizes, uninsured credits from a gross pricing perspective actually trade higher than insured credits of the same sizing. And what you're observing there is a premium that the largest sellers have in the market that are able to offer indemnity to the buyers of those credits. In terms of the composition of credits that have insurance, we see about 70% of ITCs have insurance, with 30% relying on the parent guarantee. A much lower percentage of production tax credits have insurance, though it varies a lot by credit type. All carbon capture deals in our sample had insurance. About 40% of advanced manufacturing PTC deals have insurance, largely relating to eligibility and qualification, and no production tax credit associated with wind reported insurance. So in established types like wind, it is proving to be less necessary. This data that I'm showing here is the observed incidence of historical recapture. This has not been data that has previously been aggregated. The way that we did this was in a prior survey where we went out to the top law firms and tax advisors in the space and asked them how many deals they had done in transferability and tax equity and what recapture they had seen, what the incidence had been in their portfolios of deals over time, and found that they were able to identify more than 500 deals with a historical incidence of recapture of less than 1%. Now, we don't have full cohort data, of course, here, because recent deals wouldn't have gone through the full life cycle, but still it is demonstrating what those in the market have observed over time, which is that actual incidence of recapture is pretty low. Recapture is usually partial. So the actual loss given recapture is low to buyers. And I think that reality is starting to flow through into more demand coming into the market.
Alfred, for those of us who wandered in looking for Olympic coverage, could you talk a little bit about what exactly recapture is? It's when when a project fails? Is that essentially what's happening?
Yeah. So by construction of this statute, the owner of the tax credit, the taxpayer in the statute, is responsible for the risk of recapture associated with that credit. And that principally comes when a project is taken out of service for whatever reason. What we have found is the reason why projects are taken out of service is in most cases related to weather. So a hailstorm breaks the panels and they don't have appropriate insurance to rebuild. But this notion that I had of partial recapture being the dominant form of recapture, in most cases, maybe part of the project is impaired in some way, and that leads to some form of recapture, but the actual risk borne by the buyer is less than the whole. This is also where insurance and indemnity are relevant, because in all cases with investment tax credit, one of the two things is offered. Either the parent is saying, I will step in for any loss that you, the buyer, may incur, or an insurance policy is procured usually by the seller to the benefit of the buyer that will pay if the project is recaptured. and a series of other risks that the buyer may be attendant to related to the project. Great. So almost there. 5 conclusions. The 5th being the market is increasingly competitive. On the left, I am showing the percentages of projects that tried to sell their credits in a competitive process. And what we find is about 65% of credits are selling in a competitive process. And the reason for that is reasonably self-explanatory. If you're a seller and you're able to generate competition on the sale of any asset, tax or otherwise, you're going to get better results if you sell in some sort of open market context. And we're able to see the price improvement of competitive processes over bilateral deals. We see competitive processes generate a better price to the seller in more instances. And that becomes especially true as we start to see higher bid volumes on the platform. Just to substantiate that in our data, so I mentioned that high quality credits are increasingly seeing bids within the first week. We see about 77% of credits that get a bid get it in the first week, and many are receiving multiple bids. And again, the benefit of that is that the seller is able to down select for price, for payment terms, for the counterparty, whatever is most important to them, which is a really important thing for the seller to be able to navigate in a transaction. Deals are moving quite quickly. So traditional tax equity deals, for the many that have been on those deals that are on this phone call, can attest to the fact that they typically take 6 to 9 months to complete. We're seeing tax credit deals close in generally under 3 months. So with production tax credits, we see the plurality here of deals closing in 6 weeks or less. We did one deal with a utility seller and a Fortune 100 buyer that closed in 22 days. We did a smaller deal that closed in 2.5 weeks. So increasingly seeing high potential for faster deals. And we, Crux, are investing a lot in the technology to facilitate that and standardization to enable it, because high velocity is important to the market. And lastly, Eric, I mentioned the buyers are starting to look further ahead. We see about 75% of deals are just for the current year credits, but an increasing portion, 25%, we find have some component of future year credits associated to them. And as I mentioned before, that is an extremely positive dynamic for the market. If the seller is able to effectively line up the offtake of their credit before the credit is produced, it has all sorts of downstream implications and benefits to the cost of capital on the project and their access to bridge finance. And we're increasingly supporting our developers in meeting the right partners to offer that bridge financing. So lastly, what's next? That we anticipate increasingly less friction in transactions as deals start to get smoother and people have gone through these processes and starting to align on standard terminology and documentation. As more guidance comes out, the market demonstrates more certainty. We see this in pricing, even with 45X credits. Before guidance was out, average pricing was 89 cents. Once guidance came out, average pricing went up to 93 cents. So as the department continues to put out guidance, and I have to say, they have done a fantastic job of giving the market visibility here. As they continue to put out that guidance, the result will be that the credits start to appreciate further in price for new credit categories. Supply is already constrained in 2024. We at Crux have billions of dollars of active buy-side interest for high-quality supply, and we see less supply than we have demand. So very actively looking to find supply that is looking to transact in 2024, and across the board, seeing really strong pricing. So let me pause there, Eric, answer any questions you have, and then open it up to the audience here.
Yeah, we have a lot of questions coming in from the audience, so I will, and they're good questions. So I'll ask a couple of items, and then we'll go right into that. But first of all, it appears from these slides that the market is exceedingly receptive and open to transferable tax credits, just by the sheer scale that you spoke of. That the tax equity market in 2022 was 18 billion and 23 billion. That's for your standard tax credits, and just a year and a half old, you're sitting with $8 billion worth of bids on your platform and talking about hundreds of $100 billion towards the end of the decade. Do you say have you achieved success? Is this a surprise to you, or is this what you've promised your investors and what you expected, or is this an overwhelmingly positive reception to this new asset class?
I think based on the progression of what was at the time called the Build Back Better law that lived many lives and appeared to die before the IRA was passed, and the fact that the IRA was passed in the context of other very large pieces of legislation at that time, I don't think people fully internalize the gravity of that piece of legislation. It is just enormous, right? That the amount of investment that the government is making in both traditional technologies that have been successful and new technologies that are absolutely critical to the energy transition is unprecedented in history and unmatched anywhere else in the world. And, to the question of whether we are successful, not yet, right? Like there's a lot of capital that needs to get deployed to meet the goals that all of us have from an energy transition perspective. And, Eric, I noted the capacity auctions and PJM on energy pricing last week, and seeing an 8-fold increase in pricing. There's a huge amount of demand that needs to be met by clean supply, and this tax credit tool and transferability to accompany it is going to be fundamental to being successful at that. Eric, you muted.
Okay, there was cursing there. So we're not talking about just solar and storage and wind anymore. I just want to emphasize that the 45X credit opens up hydrogen production, electrolyzer production, advanced manufacturing. What else does it open up? What are the other? And you also mentioned the 45U nuclear aspect of this. So I want to get to audience questions, but just tell us a little bit about the smorgasbord of possible credits that are out there now.
There's a nearly unmemorizable list of credits that fall into the Section 45, which relate to production tax credits, and the Section 48, which relate to investment tax credits. Broadly, they're credits for advanced manufacturing. That's 45X. It gets very big. The amount of reshoring of domestic production of battery supply chains and solar and wind is really dramatic. And we're seeing that play out in the credit market here, where more and more of those credits are coming to the market. 45V is hydrogen. That conceptually gets quite large, but the credits are expected to come in size in the back half of this decade. 45U is the production tax credit for nuclear. Again, we're starting to transact on some of those credits right now. And again, that could become a reasonably large segment of the market. 45Q is carbon capture credits, which are related to the capture and sequestration of carbon off of industrial and other facilities. That credit is one where we have seen some very large trades, but there will be a lot more. And there are many more categories here.
Okay.
So broadly speaking, the way to think about this, or at least the way that I think about it, is when you put all of those letters and numbers together, it is essentially the government subsidizing all of the forms of clean energy production and the different ways that we would decarbonize and build the materials necessary in order to meet those objectives.
Sure. It's all of the above, and it's not just solar and wind anymore. Sure. All right. Let's get to the audience. First of all, just here's an attaboy, attagirl, $1.3 billion bids in a day. Super impressive. So you're getting a compliment there. What you started to answer this a little bit, but what are the there's not a single number you can answer, but what are the credits selling for currently, and how does that? And I know it varies by deal size and the type, but where does it stand, and what do you expect of it?
I shared some of those pricing curves in the presentation. There are more in the full report. Generally speaking, we're seeing investment tax credits on average at 92 in 1/2 cents. Again, there's a lot of variance there based on size and technology type. And production tax credits are trading on average at about 95 cents with the similar dynamics on size, though they stay up in price a bit more at the low end of the curve.
Okay. Herman Travish, hello, Herman, asks, what portion of transactions involve traditional tax equity providers? So is it the same 10 banks that you normally deal with, or does this open up the Russell 3000 and a slew of other players?
That's a fantastic question. I'm glad you asked it, Herman. So the traditional tax equity was generally provided by large financial institutions. It looked more like it was an investment into the project in order to redeem the tax credits associated with that project. That market was overwhelmingly provided by many of the large banks. Those large banks, those large traditional tax equity banks, remain quite active in the market, as do others that are increasingly devoting resources to tax equity. That's very constructive, because for the largest credits, utility scale credits that are being sold, many are still using traditional tax equity as a mechanism to establish the fair market value and to monetize depreciation. And then the partnership ends up being the seller of the credit. So that the two tools are quite complementary to each other. Traditional tax equity is not relevant in credit categories like 45X advanced manufacturing, but quite relevant for wind, solar, a little bit less so battery storage. And so as a result of that, we see about 15-20% of credits that are being sold in the market coming out of tax equity in some form. And we, Crux, are very active in the partnerships that we have with financial institutions, banks, who often are sellers in our market and sometimes are using Crux to manage deals and source supplier demand.
Okay. Just a reminder, you can access the full report under the handouts button above or on Crux's website, and you get a lot more detail than Alfred provided. Here's a good question. Can you address nonprofit participation in the IRA tax transferability direct pay? Is that something that comes up?
Another great question. There are essentially two modalities of tax credit monetization. There's transferability, which we've been principally talking about, and there's elective pay, direct pay. The construct on direct pay is I have a credit and I bring it to the government. The government pays me the cash value of that credit. That is available to nonprofits of all different shapes and sizes, including governments. And the implication of that is that you get paid the full dollar, but you wait for when the IRS redeems that dollar. In a certain category of credits, 45X, advanced manufacturing, 45V, hydrogen, 45Q, carbon capture, there is a 5-year period where those credits could elect to take direct pay or transfer. And many are electing to transfer, given the pricing that we are observing in those markets and the fact that there's a difference between the cash received now in the transfer market versus cash received later in elective pay. And so some nonprofits who do not have that choice, can only use elective pay, have made the point to the government that it would be beneficial if they could also access the transfer market to pull forward the receipt of the cash associated with the credits.
Okay, we're running out of time. This went surprisingly fast and engagingly, so yay tax credits. But here's a good question. Certainly, the monetizing tax credits fast speeds up transactions and increases liquidity for the players in the transactions. It makes the market work more efficiently. But can you address how it might facilitate an equitable energy transition? And there are credits for energy communities or for domestic content, but so maybe the answer is not much, but it certainly addresses inefficiencies in the market. How does it address an equitable energy transition? It's a big question.
Great question. By construction of the credits are enhanced, as you mentioned, if they are built in an energy community, defined in a bunch of different ways, but being census tracts where coal plants have closed and other communities that are impacted by the energy transition. Low and moderate income projects that sell a disproportionate share of power to low and moderate income consumers also get an additional adder. So there's, by construction, more benefit that goes if you're building in areas that have historically not been the places where people have built these projects. Also, by virtue of the fact that the transferable market is a more accessible market that provides for more monetizable credits than the traditional tax equity market, which historically did not particularly participate with credit sizes below $50 million. That cut out a huge swath of developers that are now able to sell directly into the transfer market for cash. So I think on both fronts, it enhances the equity of the program.
Okay, we have great sophisticated questions coming in, and we're not going to be able to get to them in this session. Katie and Alfred, will you be answering these folks in your ample spare time after this forum is over? Is that something?
Yeah, absolutely.
These are your people, your customers and stakeholders, and they want more information. So,
absolutely, yes. Please reach out, fill out the lead form on our website, contact the people that you know at Crux. I am Alfred at cruxclimate.com. Send me an email. Would love to connect to anybody who has further questions and wants to participate in this market as a seller, buyer, or intermediary. We are very much open for business and looking to make this market as efficient, deep, and liquid as possible, as quickly as possible.
All right. Well, this was a Canary Media webinar. Crux is at the dawn of a new asset class that's going to help the energy transition and going to help reshore American manufacturing, another layer in the financial stack. And they've made a lot of progress in the short time that they've been on the scene, and I'm sure they're going to be putting out more reports on their progress in the coming quarters. So, Alfred and Katie, thank you very much.
Thanks for having us, Eric. Thanks everybody for joining.
Thanks everyone.
Thank you all.